Warning, there's a key shift underway in global markets right now that will have devastating consequences for millions of investors this autumn. The big market sell-off on Friday, August 26th, following Fed Chair Jerome Powell's speech in Jackson Hole, Wyoming, is just the start of the second wave of the everything bear market that started earlier this year. In particular, the summer rally in stocks is now over, and I expect the S&P 500 to break down below its June 16th closing low at about 3,700 in just a matter of a few weeks. Ultimately, my research suggests the current bear market won't be over until the S&P 500 breaks down to at least 3,000. And that's about a 26% decline from its recent close. And the scariest part of all of this is that that target is likely to be conservative. Simply put, given still stretched market valuations and the inflation mess we're currently in, I can easily see this bear market resulting in a 50% total market decline from January peak levels down to around 24 or 2,500 on the S&P 500. And what really has me worried is that the S&P 500 is actually likely to be pretty resilient. I expect much bigger declines in many popular stocks, exchange-traded funds, and quote-unquote investments that I'll talk about here in just a few minutes. For example, my research suggests Bitcoin will decline below $3,500 from its peak of more than $67,000 last year, and a current trading level of around 20,000. I'm looking for the ARK Innovation ETF, the popular momentum growth ETF managed by Cathie Wood that returned 152.8% in 2020, trading under the symbol ARKK. I expect that fund to decline to around $15 to $17 from current levels over $40 and its late 2021 peak of $156.58. And the most dangerous part of all this is that many of the supposedly safe or defensive investments that form the cornerstone of many investors' retirement plans right now also face sickening losses in coming months. Listen, I know that might seem like I'm exaggerating the risks, and some of these bearish targets may even seem extreme right now. That's especially true given that even after the Jackson Hole sell-off, there are still many so-called market experts saying that June marked the lows for the current bear market, and that the US can avoid recession or, at the very least, just see a mild downturn. Many are even urging investors to buy the dip, an echo of the strategy that worked so well back in the spring of 2020 amid a V-shaped bounce in the S&P 500 led by growth and technology stocks. Look, I didn't record this presentation today just to scare you. I created this presentation because I'm concerned. I'm actually very worried that many individual investors will use the experience of just the past few years amid the urging of these so-called experts and politicians to conclude the selling is overdone. They'll take the consensus crowdthink view of so many pundits in the financial media right now to heart, and they'll buy this dip. I must warn you, this could well be the single most dangerous market environment I've seen since at least the Great Recession years of 2007 to 2009. And so I urge you to watch this video through to the end, examine the facts, charts, and evidence I'm about to present before you even think about buying this dip. And only then decide for yourself if my concerns and bearish targets are valid or if I'm just another analyst full of hot air. However, before I get into all that, I should probably back up for just a moment and introduce myself. My name is Elliot Yu. 10 years ago, I co-founded a market research and financial publishing firm called Capitalist Times that's quickly grown to serve thousands of individual investors as well as market pros all over the world. I should warn you, I'm no stranger to making bold, unpopular calls. When I warned our readers that oil prices would collapse way back in 2014, 8 years ago, and predicted that many popular high-flying energy stocks of that era were destined for bankruptcy. Some investors balked, others even laughed at me. When I published some of my research on popular financial website Seeking Alpha, warning readers to sell deepwater driller Seadrill, I received literally hundreds of comments, overwhelmingly calling me a fearmonger and much worse. To be accurate, the exact wording of many of these comments is not something I'd care to repeat here in this video. However, by the end of 2014, oil prices had collapsed, entering an 8-year bear market, and Seadrill slashed its dividend, sending the stock on a death spiral that would end in bankruptcy court, as I predicted. And as recently as late 2021, just late last year, on news of the spread of the so-called Omicron strain of coronavirus, a new strain of coronavirus, I ruffled quite a few feathers when I wrote that the stock market was done with COVID. I even took down a post I'd made on Twitter over fears of getting banned for quote-unquote misinformation. I then warned that there was an even bigger risk than COVID on the horizon, a much bigger risk, an economic and market tsunami that would wipe out many popular and high-flying growth stocks. In early December of last year, 2021, I even advised readers of my Creating Wealth service to buy inverse exchange-traded funds, specifically the ProShares Ultra Short NASDAQ 100 ETF, which is designed to rise in value by 2% for every 1% decline in the value of the NASDAQ 100, and the Short Innovation ETF, trading under the symbol SARK, S-A-R-K. Again, some thought I was being way too cautious and too bearish. Even thought concerns about Omicron would prompt investors to actually buy growth stocks over economically cyclical issues. However, the critics were silenced as the NASDAQ lost almost 1/3 of its value to start 2022, and the Short Innovation ETF I recommended readers buy jumped as much as 108% this year. I'm not telling you this to boast or brag. Rather, I reference my success and experience with out-of-consensus contrarian calls because I believe the coming market storms and the resulting devastation of the savings of millions of investors could be even worse, much worse. You see, the truth is that markets, indices, and individual stocks make large percentage moves almost every year. But true regime changes, where there's a major shift in the underlying drivers of stocks and economic conditions, are decidedly rare. However, right now, I believe we're witnessing just such a crucial shift: the death of the policy-driven markets and capital misallocation of the past several years. The death of an economic and policy phenomenon, what I like to call the new school of finance, that's already having devastating impacts on the US, the European Union, China, and other major global economies right now. Let me explain. Call me old-fashioned, but I've always believed capital markets have a higher purpose than simply providing fodder for speculators. The stock market has more meaning than just keeping people like me and presumably many of you busy between 9:30 a.m. and 4 p.m. Eastern Time every weekday. Put simply, free markets are about allocating capital and scarce resources in the most productive way possible. When a company makes a product or provides a service which benefits people, creates value, that company will tend to earn a larger profit, which in turn tends to drive the stock price higher. Of course, a higher stock price allows the company to raise additional capital needed to grow, invest in research and development, new product development, employ people, and it can even act as currency to fund acquisitions. A higher stock price also benefits us as shareholders in that enterprise, partners in the business, in the form of capital gains and traditionally regular dividend payments. Much the same can be said of commodity markets. For example, higher crude oil prices have historically acted as a carrot and a stick for consumers of oil and producers of oil, both encouraging additional spending on exploration and development, new sources of supply, while discouraging consumption or encouraging conservation. Markets fill this role because, quite simply, they work. They may not be pretty at times, and all market participants are likely to be displeased with the outcome at least some of the time. In fact, if you're like me, you've probably never met an investor who is happy with the market, the way it's trading 100% of the time. However, I believe free markets work better than any other system humanity has ever devised through the long expanse of history. That's not to say that markets are always rational, efficient, or function smoothly even. Market history is certainly replete with examples of booms, manias, and the inevitable busts that temporarily at least cause market pricing to deviate from any discernible concept of fundamental value. At times, markets cease to function properly in their core functions of allocating capital and scarce resources. It's been said that the scariest words uttered in America these days are, "I'm from Washington, D.C., and I'm here to help." Well, I believe in the future, we'll look back on the market environment of the past 13 or so years as a classic example of market malfunction, one that has its roots in efforts by the Federal Reserve, Washington politicians, and bureaucrats, other governments and central bankers around the world to, for lack of a better term, help. Put another way, government efforts to abolish the business cycle that have doomed now as throughout history to create even more destructive side effects. The stock market specifically seems to have morphed away from a means of providing capital to successful businesses into a mechanism for betting on the Federal Reserve, monetary, and to a lesser extent, fiscal support and handouts from the US government. Since the Great Recession and financial crisis of 2007 to 2009, the Fed and the US government, under administrations from both political parties, seem to have resolved to squash any budding economic or market dislocations using all the monetary and fiscal tools at their disposal. How else can you explain the record-setting boom in federal outlays amid the COVID lockdowns of 2020 as the stock market tanked? Take a look. Total US government outlays jumped to more than 30% of gross domestic product in 2020 and 2021, up from about 20 to 21% between 2013 and 2019. That's well above peak fiscal stimulus of 24.3% of GDP amid the Great Recession and financial crisis of 2007 to 2009. It's above peak spending of 22.9% at the height of the Cold War in 1983, as the economy was just emerging from the vicious double dip recession of the early 80s. In fact, the only period in history is 1943 and 1944, during the height of World War II, when federal government outlays came in just under 43% of GDP in both of those years. And there's a crucial difference. Following the end of World War II, US federal outlays dropped sharply, reaching a low of 11.4% of GDP in 1948. In contrast, while US federal spending is expected to fall from the 2020 to 2021 peak over the next 5 years or so, spending is projected to average about 23.25% of GDP from 2022 to 2027, which is well above the pre-COVID average of 20.55% from 2014 to 2019. Now, an even more dramatic shift, at least when it comes to the proper and efficient function of free capital markets, has come courtesy of the US Federal Reserve. Simply put, the Federal Reserve has become the dominant force that drives global markets, including stocks, bonds, and currencies. Since the end of the 2007 to 2009 Great Recession, the most successful rule of thumb for investing in stocks became this: forget corporate earnings, the economic cycle, elections, market technicals. Forget literally everything except the Fed. Think back to late 2018 when the stock market was plummeting, the economy was weakening, and the Fed seemed hawkish on rates. What stopped the mini bear market decline? Nothing but this. Growing market confidence, the Fed would pivot in early 2019 and stop tightening, or even start loosening monetary policy to address the growing sell-off in stocks and other assets. When the Fed obliged, the market shot higher, with the S&P 500 returning 31.2% in 2019 alone. Or how about early 2020? The government basically shuts down private businesses for weeks in a dubious effort to control the coronavirus outbreak. The economy predictably tanks, but the Fed and Washington, D.C. ride to the rescue with a package of unprecedented fiscal and monetary stimulus, including interest rates at zero, more than $4 trillion in quantitative easing, stimulus checks for consumers, and an alphabet soup of new programs to support the economy. The stock market jolts out of a V-shaped base, with the S&P 500 up about 90% from the end of March 2020 through the early January peak this year. Not to mention a 1,045% jump in shares of Tesla, a 4,267% jump in retailer GameStop, and 551.7% in Bitcoin, to name just a few. I recently read a report from Bank of America Merrill Lynch that suggested a whopping 51% of stock market returns since 2010 can be explained solely by changes in the size of the Fed's balance sheet. That is the amount of quantitative easing. While only about 23% of market returns can be attributed to that boring old fundamental known as earnings growth. That's pretty incredible, right? The stock market cares more about what Jerome Powell has to say than how much wealth and value a company actually creates. There's no denying that this new school of capital markets has produced some impressive gains for the stock market over the past 13 years. Indeed, from the March 2009 lows through the January 2022 peak, the S&P 500 produced annualized gains of almost 18.9%, while the NASDAQ Composite soared more than 23.1% annualized. That's impressive indeed. Even in the 1990s, a decade many regard as a sort of golden age for the US economy, the S&P 500 generated average annualized gains of only about 18.2%, a bit less. However, those dramatic stock market gains and the V-shaped recoveries from every sell-off and mini-crisis since 2009 have not been free. There's no such thing as a free lunch. There's actually been a hefty cost, though the bill is only now, just now, coming due. Simply put, capital markets have ceased to perform their traditional, crucial function of efficient capital allocation. In particular, quote-unquote free money has artificially inflated valuations for growth and technology stocks by dramatically boosting the value of distant future cash flows relative to near-term profit. Just consider that less than a year ago, Snap Incorporated, the company behind the social media app Snapchat that's favored by many younger consumers, a company that has never produced an annual profit, positive free cash flow, or paid any sort of a dividend, and it isn't expected to over the next several years up until around 2030 or so, had a market value of $120 billion at its peak in 2021. That's more than iconic companies like Ford Motors, General Electric, retailer Target, even household names like Deere, the agricultural machinery company, American Express, and 3M. Put it a different way, companies with little or no earnings, but a good story about the potential for future growth, have been rewarded at the expense of companies that make a product that's needed or desired right now. Only recently have shares in these story stocks started to revert to something like fundamental value, with shares in Snap down more than 87% from its highs less than a year ago. An even more dramatic example are meme stocks like GameStop and AMC Entertainment. which saw their stocks soar amid a retail trading frenzy in early 2021, and again to some extent this summer, despite a steady deterioration in underlying profitability and questionable business strategies. And take a look at shares in retailer Bed Bath & Beyond, which soared from under $4.50 a share earlier this summer, just after the 4th of July, to a peak of $30 on August 17th, despite the fact that it was in such poor financial shape that its suppliers were threatening to cut it off due to its inability to pay for inventory. Think about that. A retailer that may not have any goods on the shelves to sell this autumn, and sitting on more than $3 billion of debt that it was struggling to service, is worth about $2.4 billion in mid-August. Does a failing retailer like that seem like the sort of retailer, sort of company even, that should be attracting billions in new capital? How is that an efficient allocation of capital? You can even see the devastating consequences of poor capital allocation in energy markets. Years of government subsidies for alternative energy, coupled with a policy of shutting down nuclear and fossil fuel plants like coal plants, has resulted in a surge in European power costs to devastating levels. That's been further reinforced by ultra-low interest rates, which boost the valuations of unprofitable alternative energy technologies at the expense of slow-growing but profitable fossil fuel producers. The result? Right now, day-ahead baseload power prices in Germany are 15 times what they were at a similar time in 2019, just before the COVID outbreak. And that brings me back to the current predicament. Listen, there's a well-known phenomenon in behavioral finance and psychology known as the recency bias. Essentially, that means human beings have a hardwired tendency to place more weight on recent experience, the freshest memories, when making decisions. With that in mind, I suppose it's no huge surprise so many pundits have been focusing on the V-shaped market recoveries in late 2018 and again in 2020 lately. And that's been informing their calls for a major rally in Q4 of this year, of 2022. That's a consequence of conditioning and experience provided in the 13 years since the global financial crisis of 2007 to 2009. However, while it went unnoticed by most market participants, the evidence has been mounting that this new school of finance, the era of extreme easy money, the government and Fed propping up the market on every dip, has been reaching its practical limits. Of course, one symptom of this is the surge in real inflation since 2021 to the highest levels in 40 plus years. That's now being felt by both Wall Street and, particularly so, by Main Street. However, the evidence goes back further than that. The hard truth is that non-traditional monetary policies like quantitative easing have been gradually losing their efficacy for many years now. Just consider, between March of 2009 and March of 2010, the Fed bought about $400 billion worth of treasury bonds and mortgage-backed securities in its first round of quantitative easing that's come to be known as QE1. That was equivalent to about a 20% expansion in the total size of the Fed's balance sheet. And over that one-year period, the S&P 500 surged about 49%, almost 50%. Then, just a few years later, in September 2012, markets dropped again, so the Fed started another round of quantitative easing, which is now known as QE infinity. And that brought the balance sheet expansion up an additional $1.7 trillion, which was a 58.7% expansion in the size of the Fed's balance sheet at that time, before they finally came to an end in October 2014. Now this time, the S&P 500 also jumped, but by just 45%, or only around 19.6% annualized. And that's less than half the pace of gains in the first round of QE in 2009 and 2010. The market responded to a much larger round of quantitative easing, more than 4 times the size of QE1, with smaller gains. Most recently, of course, the Fed purchased $4.8 trillion in Treasury and mortgage bonds between March 2020 and March 2022 this year. expanding the size of its balance sheet by a whopping 114%, more than doubling. That's the largest QE ever conducted in both raw dollar terms and percentage terms by a huge margin. Yet the S&P 500 rallied just under 80%, about 34.2% annualized. In other words, while QE undoubtedly works in terms of boosting the value of the stock market, each successive round has required a larger expansion to have a smaller effect. As I mentioned a little while ago, I believe we're witnessing a generational shift in global markets. The death of the policy-driven markets and resulting capital misallocation of the past several years. The recent speech from Fed Chair Jerome Powell and Jackson Hole is just the latest example, or maybe even admission, of this shift that's already well underway, even accelerating right now. Powell seems to have convinced the markets looking, or even just hoping for, signs of a pivot on tighter monetary policy, that the Fed really does plan to maintain financial conditions, tight financial conditions, even if that policy risks sending the U.S. economy into recession. The yield curve, measured as 10-year Treasury yields less 3-month T-bill yields, last week flattened to near its cycle lows of about 22 basis points. Regardless of whether the Fed hikes 50 or 75 basis points in September, I'm looking for this curve to invert this autumn and for the U.S. economy to slip into recession by early next year. How did Powell surprise markets as hawkish amid a market prepared for a very hawkish speech? The answer, in my view, is that he brought up the 1972 to 1982 experience on multiple occasions in his speech. Specifically, note this passage from the speech. Quote, "We must keep at it," talking about interest rate tightening, "until the job is done. History shows that the employment costs of bringing down inflation are likely to increase with delay as high inflation becomes more entrenched in wage and price setting. The successful Volcker disinflation of the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. So let me back up and summarize in brief a bit of financial history to explain that line about multiple failed attempts to bring down inflation that Powell referenced in his speech. In the first 9 months of 1973, the U.S. Federal Reserve, under then Chairman Arthur Burns, steadily tightened policy, driving up the effective Fed funds rate from about 6% at the beginning of the year to around 11% in the summer months. You can clearly see this early 1973 tightening phase in the red box in my chart. By the summer of 73, there were some tenuous signs of moderating inflation, due in part to higher interest rates and the resulting slowdown in the U.S. economic growth. The month-over-month change in headline CPI retreated from about 0.9% in March 1973 to unchanged in July of the same year, month over month. The year-over-year change in the Conference Board's leading index softened from plus 10% at the beginning of 1972 to plus 1.2% by September 1973 and negative 3.6% by the end of 1973. So as you can see, the Federal Reserve began to take its foot off the proverbial brakes in September 1973, and by early 1974, the effective Fed funds rate had fallen back to around 9%. The economy, for its part, officially slipped into recession in November 1973. However, declaring the war on inflation over was premature, and inflation reaccelerated straight through 1974. The core CPI surged from 3.2% in August 1973 to 4.7% in December of the same year, topping 10% by September 1974, before finally peaking in early 1975. Of course, that necessitated even more aggressive tightening in 1974. The effective Fed funds rate surged from 9% in early 74 to a peak of more than 14% in the summer and autumn months of that same year. The scariest thing of all is that even that second 1974 surge in rates still wasn't enough to bring down inflation on any kind of a sustained basis. Core inflation did peak at 11.7% year over year in February 1975, falling to around 6% by 1977. However, inflation never actually fell below 5.9% in the latter half of the 70s. And by 1980, it was setting fresh highs of 13.6% year over year. The reason? The Fed's surge in rates in the first half of 1974 slowed the economy, slipped into recession, and it began to bring down inflation. But the central bank sniffed nascent signs of falling inflation and began cutting rates in 1974 to stimulate growth. The effective Fed funds rate fell to about 5% by the summer of 75. The economy and stock market recovered, but inflation stopped falling. In short, the Fed declared victory too early in 1974 and 75 due to a decline in inflation from 11.7% in early 75 to under 7% by year end. And the result was simmering inflationary pressures that plagued the economy through to the early 80s, when a new Fed chairman, Paul Volcker, referenced 3 times in Powell's speech and Jackson Hole, finally brought down inflation at the cost of a vicious double-dip recession. Now fast forward almost 50 years to the present time. Inflation is down, literally just a few tenths of a percent from 40-year highs. That's even thinner evidence of so-called peak inflation than what drove the Burns Fed to cut rates in late 73 and again in late 74 and through 1975. The idea of the inflation dragon has been slain rests on an extraordinarily weak foundation. After all, while July CPI may have come in softer than expected, it's worth remembering that headline inflation remained at 8.5% year over year last month. Core inflation, excluding food and energy prices, came in at 5.9% year over year in July, unchanged from the June level. Yes, that's down from a peak of about 6.5% year over year earlier this year, yet even at 5.9%, it's still the highest it's been since 1982. Dig a bit deeper, and the inflation news looks even worse. Unit labor costs, which is a measure of the cost of labor relative to real inflation-adjusted output and production, recently soared to the highest levels in 40 years as well. Labor costs are arguably the most dangerous driver of inflationary pressures. That's because when inflation gets ingrained in consumer psychology, they start demanding faster growth and compensation, which in turn requires companies to raise prices even further to offset profit margin headwinds of increased labor costs. In a nutshell, that's the vicious cycle, the wage price spiral that plagued the US economy during the great inflation years of the 1970s. And, as the chart clearly shows, the recent surge in labor costs looks much as it did 50 years ago. Now, I agree that inflation may be peaking right now in terms of the year-over-year change, but that does not mean the war against inflation has been won. Indeed, history tells us the battle is now entering its most critical and dangerous phase. Also, while the economic data has weakened significantly since the beginning of this year, and is at levels that have historically signaled at least a mild recession, the economy is much, much stronger today than it was back in late 73 and throughout 1974. For example, the unemployment rate as I record this presentation is 3.5% compared to 4.5% to 5% in 1973 and north of 8% by 1974. So what do you think would happen if the Fed were to suddenly pivot, as so many bulls have declared, and even declare a plan to start easing policy rates in 2023? I suspect 3 things would happen. 1, the stock market would jump, led by growth stocks and the NASDAQ, which would serve to ease financial conditions and stimulate economic growth. 2, the economic data would begin to stabilize and even pick up again. 3, inflation, while it might continue to drift lower on a year-over-year basis near term, would likely stabilize at levels well above the Fed's target and then begin to rise yet again, just like it did in the 70s. In short, we'd repeat the experience of the late 74 to 80 era. The very definition of the stagflation and misery economics of the late 1970s, including high unemployment and high wealth-destroying inflation. Except this time, we've made even less progress on inflation than the Burns Fed did back in 1974 and 1975 when it performed its infamous pivot and started cutting rates. If the Fed is to avoid repeating mistakes of that era and the resulting economic devastation, it must keep raising rates now and maintain rates at a restrictive level for some time. In short, Powell told markets that the Fed will not be able to indulge traders with another pivot and V-shaped easy money risk rally as they did in 2018 and 2020 and so many times since the Great Recession of 2007 to 2009. Of course, a return to more of an old school market environment driven by fundamentals like the health of the economy and corporate profits is actually not good news for financial markets, the stock market in particular, near term. It's particularly bad news for pure growth earningsless stocks such as Snap, AMC Entertainment, and GameStop that I mentioned earlier. However, as I'll detail in just a moment, longer term, this is an encouraging development in my view, since more rational markets grounded in real fundamentals can return to their crucial role of efficient capital allocation. So that brings me to the most important two questions of all. First, how bad could things get amid this seismic shift in global markets? And second, what can you do to protect and grow your wealth over the next several months as we work through this economic mess? Well, let me explain in the simplest terms possible how I see it all playing out. First up, there's an old rule of thumb that markets, stocks, and sectors that go through a bubble phase eventually return to their pre-bubble trading range, or worse, they retrace all the bubble era gains. For example, look at this chart of Cisco Systems from the mid-1990s through to 2005. Do you see how this stock, one of the leaders of the dot-com tech boom of the late 90s, soared from a split-adjusted $10 at the end of 1997 to more than $80 in March 2000, and then back to around 10 in 2001 and 2002, a round trip in less than 5 years. And this isn't just some fly-by-night hopes and dreams outfit. Cisco Systems still exists today, is still in the S&P 500, and currently has a market cap of almost $200 billion. Or how about this one? This is a chart of Countrywide Financial from 2000 to 2008. Countrywide was one of the leaders of the real estate and credit boom of the 2002 to 2007 era, rising from a split-adjusted $12.50 a share in late 2002 to as high as $45 in early 2007, a return of more than 35% annualized and about 250% in total. Before it actually collapsed to be acquired by Bank of America in the summer of 2008 in an all-stock deal that was worth around $4.25 per share of Countrywide at the time. Well, look at the NASDAQ 100 over the past few years. Do you see how the NAS doubled from about 8,000 here in 2019 to around 16,000 at the peak? And when the fiscal and easy money boom following the 2020 COVID outbreak powered tech and growth sectors higher? Well, here we are today at around 12,600 or so. And if the history of past speculative manias is any guide, we could easily see the NASDAQ 100 return to its 2019 trading level around 8,000. An additional 35 to 40% decline from current levels, 50% decline from the peak. And since the stocks in the NASDAQ 100 have come to dominate the S&P 500, that equates to a sub $3,000 index level for the S&P 500 from over 4,000 currently. Or how about pseudo assets like Bitcoin? As you can see, Bitcoin traded from around $7,250 in late 2019, then went parabolic in late 2020 to reach a height of $67,734.01 in 2021, all powered by the easy money and fiscal boomflation of the past few years. I see this cryptocurrency doing a full retracement to under 7,500 by early next year, and eventually I see Bitcoin retracing all the way back to its 2018-2019 lows at under 3,200 bucks. So that brings me to the second question. What can you do to protect and grow your wealth through the coming market storms? Now, to be honest, I could fill 20 presentations like this and not cover all the bases on that question. Because the truth is my research suggests we're likely to enter the heart of the coming market storms in roughly the September through February of next year period. So that's the next 6 months or so. And that means you'll actually have to be a little bit nimble over this time period in your investment allocations. In short, what I'm recommending to readers of my Creating Wealth service right now is to approach this market in what amounts to 2 phases. The first, over the next 6 to 9 months or so, it will be crucial to focus on downside risks, avoiding the pitfalls in certain sectors, and controlling risks, discipline, on stocks you want to accumulate, while directly taking steps right now to benefit from the market meltdown I expect. Most of all, you'll have to be a bit nimble if you want to prosper in the short to intermediate term. Now, I decided to rush this video out to you today because the shifts are happening very quickly, much faster than I'd expected just literally a couple of weeks ago. So I didn't have time to prepare a bunch of free reports to send you. And to be honest, given how fast things are changing, any reports I did create would probably be out of date just a day or two later. So instead, I've authorized my team at my publishing firm, Capitalist Times, to open up risk-free trial memberships to my Creating Wealth service at the lowest price that we've ever offered. That way, you can follow along with exactly what I'm recommending in real time. And you'll be the first to know of any changes to my recommended model portfolio via immediate and frequent flash alerts. In fact, in recent days, I've added several recommendations to the service, stocks and ETFs, that I believe require your urgent attention. I'd like to rush those recommendations to you today as part of your risk-free trial. Here's how it works. To activate your risk-free trial right now, simply click the button adjacent to this video. That'll take you to our risk-free secure order page where you can start your trial at the lowest price we've ever offered of $299 per year, a full $100 off the lowest subscription price we've offered in the past. As soon as your trial is confirmed and you accept my invitation, I'll rush you the last 2 issues and alerts for Creating Wealth, published in recent days, including my latest recommendations in PDF format direct to your email. After that, you should expect to receive at least 2 issues of Creating Wealth each month, supplemented by frequent flash alerts with new recommendations, advice or updates on existing recommendations, and market-breaking news. You'll also have access to my members-only email if you have any questions. Try the service then for the next 60 days, 2 full months, and if you don't believe it's worth every dime of the subscription price, if it doesn't help you navigate the market storms I expect over the next 2 months, simply call us or email us to cancel your subscription for a full refund of your $299 subscription rate. I guarantee it. Now, just a minute ago, I also told you that I'm looking for this crisis to evolve into 2 phases. The first and most intense over the next 6 months, followed by a second phase thereafter. Let me explain. It's often said that capitalism and free markets work through creative destruction, where failed companies and economic models and policies are destroyed and replaced by companies and economic systems that work. That, in a nutshell, is what I expect over the intermediate to longer term. We will not be able to go back to the easy money and policy-driven markets of the past 13 years or so, because to do so would reignite inflation and lead to further capital misallocation that's caused us so many headaches in recent years. Rather, I expect to return to more of an old-school system where markets are driven by fundamentals like earnings growth, valuations, and return on capital. What that means for investors is that some sectors have been starved for capital amid the easy money boom years and that have benefited from that. Other sectors that have not benefited from the easy money boom stand to benefit in the coming environment. These sectors will need to see capital inflows to correct the imbalances of the past few years. In short, I expect tremendous buying opportunities in the spring and summer of next year. However, as is always the case following bubbles of this nature, the leaders of the next big bull market will not be the same names that led the last advance. To activate your risk-free trial right now, simply click the button adjacent to this video. Thank you for your attention today. I look forward to welcoming many of you as new members here in just the next few minutes. Again, to activate your risk-free trial right now, simply click the button adjacent to this video or give us a call toll-free on 1-877-302-0749. That's 1-877-302-0749 between the hours of 9 a.m. and 5 p.m. Eastern Time. Thank you very much for listening to me today.